Personal income is the sum total of all the incomes that are actually received by the households from all the sources. Which are the sources? The sources are earned income and unearned income. Earned income is the factor income in the form of rent, wages, interest, and profit. And unearned income is the transfer income in the form of gift, donation, old age pension, scholarship, etc. In the previous module, we were discussing about private income. Private income is a broader concept because private income includes the income of the private firms and households, but personal income is the income of the households only. Private income belongs to both the private enterprise and household, but personal income refers to that part of the private income which is received by the households only. And in private income, there is corporate tax and corporate saving. Corporate tax and corporate saving. Corporate saving is otherwise called retained earning. They are the income of the private firms. It does not belong to household. So we have to deduct from private income the corporate tax, otherwise known as profit tax, and retained earnings, otherwise called corporate saving. These two are to be subtracted or deducted from private income in order to arrive at personal income. Corporate tax are taxes paid by the private enterprises to the government and are not received by the household. Likewise, retained earnings, they are the corporate savings. They are retained by the private enterprises for their future expansion and unforeseen events. They don't belong to the household. So we are deducting corporate tax and retained earnings from private income in order to arrive at personal income. So what is personal disposable income? It refers to that part of personal income which is actually available to the households for consumption and saving. Personal income includes personal taxes. When we deduct these taxes from personal income, we get the disposable income, the income available to the household or individual to spend for, or we say for consumption. A household or individual, they have to pay income tax, property tax and other receipts of the government. So after deducting the amount of such payments, one has the income to be spent at one's wish. So personal disposable income is equal to personal income minus personal taxes minus miscellaneous receipts of the government, or consumption plus saving. For example, if personal income is 10,000 rupees every month and personal taxes 1,000 rupees and miscellaneous receipts of the government 1,000 rupees, so personal disposable income will be 8,000 rupees. After the payment of 2,000 rupees, the disposable income with the individual or the household is 8,000. This he or she can spend for consumption and saving.